When you look to invest in a stock and fill in their stock ticker, there is one very enticing and seductive number that is displayed: the dividend yield. This is, in essence, the percentage of your share purchase price that you got paid out by the company last year, and hopefully also in the coming years. So if you invest in a company that has as high a dividend yield as possible, you get the largest sum of proportional invested money back as straight up cash, minus a 0 to 30% tax depending on where you live. And this is very true. If you want to see fast returns, then buying a stock with a high dividend yield is certainly a way to achieve that. But there are a few things that you should keep in mind when doing so. If a stock price is low compared to its issued dividend, you'll have to wonder why. Let's go through a few possibilities. Number 1. The business is very cyclical and the company wants to reward shareholders for sticking with them. This happened, for example, to Zim back in 2021-2022. Zim is a bulk shipping company that leases most of its vessels. Once bulk shipping prices increase, like what happened during the supply chain bottleneck of COVID, Zim made a killing on its leased ships. They made an absolute fortune. But what do they do with this cash? Lease more ships? Buy more ships? Well, given that supply chains are probably back to normal shortly, this might just be a terrible investment. So instead what they did is they issued basically all of their profits as dividends. Their share price has since come down a lot since their earnings aren't anything special anymore. But since they issued such massive dividend, their dividend yield currently stands at 78%. Would I buy this company though? With the way that shipping costs are coming down, not really. I don't expect them to be too profitable in the future. Number 2. A business has no good returning investment it can make. The metric ROIC, or return on invested capital, is very important for anyone wanting to make an investment. Many consumer giants like Procter & Gamble or Unilever face this problem. If they invest in additional marketing or launching a new product or a different variant of a product, the profits they made from this are often quite minimal. Shareholders can expect a higher return if they are just given the cash straight up to reinvest for themselves. Therefore, a company will often pay a higher dividend yield if they themselves see no good way to deploy their capital. Number 3. A company is sacrificing growth. Big companies like Amazon or Meta have been growing into powerhouses in a relatively short amount of time. And one of the reasons for this growth is the fact that they can reinvest all of their profits back into their business. You can imagine if you spend 90% of your profit on dividends, as seen with REITs or real estate investment trusts for example, that the amount of growth this company can make is very limited. They have way less cash to work with. And number 4, a company is diluting the share count or accruing debt. Now, this is a major red flag if it does happen. The moment that a company goes into debt is risking its own financial health to pay you money. Over the long term, this is simply unsustainable, and personally, I rather have a company I invest in to be at no risk of shrinking or bankruptcy. We also see stocks diluting their share count to pay the dividend, as seen with the Italian construction company Webuild. They dilute their share count to pay their dividend, which is basically paying investors with their own money. Again, in the long term, this is unsustainable and terrible for investors. And these are just a few reasons why chasing high dividend yields can be a dangerous choice. It is always important to look at the financials of the company itself, like we do every week, and based on that determine whether the company's dividend is secured and manageable. Personally, I prefer to invest in a dividend growth company. They are usually companies that pay around a 1% dividend yield and invest most of their capital into expansion and share buybacks. This way, in a few years or even decades, because the earnings are increasing and the shares to which to distribute these earnings to are decreasing, I can expect a fast growing dividend in the future, even though I sacrifice immediate returns now. Companies that do this are companies like Republic Services, Visa, Microsoft and Apple. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!